want to thank all of you for joining us today for the third annual Capital Summit. We have a number of, all of you are friends, and we appreciate your support and attendance today, particularly on a Friday afternoon, which is always tough for any type of event. But I think the quality of the speakers and the panelists that we've had today is really the reason why you came, and I've gotten a lot out of the session. And I think this finale is really a grand finale, and I'm really honored to have John Rogers here as our guest. He came in from Chicago to Boston, and so we really appreciate his participation in this event, and we are honored to have him. And I don't know if you took the opportunity to read his bio. I am not going to read his bio because we want to get to the nitty-gritty. And but I encourage you not only to read the bio that's in the program book, but go to his website. Go to Ariel Investments website. It's a phenomenal website. It talks, and I've spent my time. I did my homework.
Oh, good.
It's really if you're looking for financial literacy sources, it's got that there. If you're looking for terminology, it's got that there. If you're looking for their strategy, their history, it's all there. If you're looking for what the news is saying about Ariel Investments, it's there. So I encourage you to do that. John and I actually met many years ago because we have something in common, and it's through marriage. But I'm not married to him. But my wife is a Princetonian. And John is a Princetonian, and my daughter's a Princetonian. So my wife and daughter both graduated from Princeton, and we met at a Princeton graduation many years ago. But I've also been in the room with John on many occasions where he's been a keynote speaker in New York, but also with NMSDC events. And so, again, we are really fortunate to have him here to talk about a number of things. And what we decided to do today is, instead of having John give a speech, we have some interaction with John to talk about some of the things that they're doing and some of the things that they've done. And that'll be helpful to you, whether you are a corporate member of the council or a minority business owner. And, the great thing about John and Ariel Investments is that he comes to this with many different perspectives. He's an entrepreneur, okay? And we've talked a lot about entrepreneurship today. He's a CEO. Many of you in the room today are CEOs. He is also an investor. So he invests in businesses. Many of you are looking for investment. He is also a civic leader. So he has these different perspectives that he can bring and share with us. And I want to just start off the questions by asking John how you got started. How did you get into the business of Ariel Investments, which today is one of the leading investment companies in the country?
Oh, well, thank you. I'm pleased to be here, and I know I'm hoping we'll have a chance to have some dialogue and discussion after we have the brief interview. But Ariel is 30 years old this year. So we've been at it for quite a long time, and I got started a couple things that were really instrumental in getting me going. Number one, my father used to buy stocks for me every birthday and every Christmas after I was 12 years old, instead of toys. And at first that wasn't a lot of fun, but he made the good decision to allow me to get the dividend checks. And so every quarter, every 3 months, I would get a check in the mail from some of the blue chip stocks that he bought me. And he wasn't wealthy. It was $500 worth of stock here, $250 there. And I'd get the $10 check in the mail, and it was really pretty nice. And that got me excited. And I went to Princeton and played basketball there. And I was the one guy on the team that had my Forbes and my Barron's and my Fortune and my Black Enterprise for the long bus rides up here to play Harvard or wherever we were going that weekend. And it became a passion of mine. Mm-hmm. And I had a role model that was my dad's stockbroker, my mom's stockbroker, a gentleman named Stacy Adams, who was the first African-American broker on LaSalle Street in Chicago. And we were just talking about it earlier with a friend of the family, which is great to hear about that. And So he was my role model, and so I thought if you loved the stock market, you became a stockbroker. And I went to work at a firm called William Blair in Chicago, which was a great place to train because William Blair was a regional brokerage firm, and it had everything there under one roof: investment banking, venture capital, private equity, trading, just every aspect that you could think about it within an investment bank. And after spending 2 years as a stockbroker and working with individual investors, I realized I was kind of miscast, that I'd be better off being a money manager, managing people's assets, the way Fidelity does here, and some of the, having a mutual fund for individual investors that you can manage, and then having institutional portfolios that you can manage. And what helped a lot, being in Chicago, there were so many successful African-American entrepreneurs who were great role models. You had John Johnson with Ebony and Jet Magazine. You had George Johnson, who had created Afro Sheen and Ultra Sheen. Had Tom Burrell, who had Burrell Advertising, Independence Bank. So we had these leading institutions, whether it was banking or advertising or hair care or publishing. And I kind of thought I had this idea around money management and mutual funds. And there had never been an African-American money management or mutual fund company in the country. So that was an inspiration to try to be a pioneer. And then finally, I had an investment strategy and philosophy that I believed in, focusing on smaller companies that were undervalued, that I thought could grow consistently. And there were not a lot of money managers back then doing that. So we thought we were kind of original with our investment concept and philosophy of how we were creating our business back in 1983.
Okay. Well, let me ask you about your investment philosophy that you mentioned, that you've stuck with over the years. And one of the things you'll see on his website is a turtle.
Right.
Can you explain the turtle and the significance of the turtle in your company's strategy and development?
Sure. When I started, I was 24, and I was trying to figure out how am I going to get individuals or institutions, large university endowments or museum endowments or corporate pension funds, to trust me with their money, because I was such a young kid. And I thought, how can I get people to feel like I'm a prudent investor? And I started thinking about that, and I said, well, maybe if I come across with the idea of being a patient investor, someone who was going to invest for the long run, wasn't going to take undue risks with people's money, it would sort of, get people comfortable and relaxed with investing with me while I was building a track record those first 2 or 3 years. And I also thought the nice thing about the patience idea was it came with a motto, slow and steady wins the race, and a icon, the turtle, because that old Aesop's fable where the tortoise beats the hare, wins the race. And I thought that was kind of a nice theme that would really help us put us on the map. Because if you think about it, everybody else has these sort of much more ferocious types of, Merrill Lynch had the bull, and T. Rowe Price had the ram, and Dreyfus had a lion, so we had the turtle.
Well, one of the things about entrepreneurship, and I commend you for the turtle metaphor, because entrepreneurs usually are running around with their hair on fire. And it's difficult to hear or to talk to entrepreneurs about slow and steady. But, you've been in the business for a while now, and so it's worked. Any advice you would give to entrepreneurs about the importance of having a core strategy? You have one, but what else? What value is that to other entrepreneurs?
Well, I think in the beginning, what I always felt was that it was going to take at least 3 years to break even. And I know a lot of you have been through that process. And I went to friends and family to raise the capital to start the company. My mom gave me basically all of her liquid money. She gave me, and my dad gave me what he could afford to lose. He was very conservative. And I went to some of my former clients who I had as a stockbroker and friends from high school, and raised, I guess about $300,000 roughly to start the business. And then after that, after the first year, we ran through all that money, and I went out and raised another couple $100,000. So over probably a 3 or 4 year period, I raised $500,000 to keep the business solvent. And to answer your question, the thought was that we would be very focused on our investment strategy, only try to do one thing well, and learn from our mistakes, learn from our experiences, and that it would build over time. Because if in the beginning, if we didn't get much money to manage, which we didn't, I think that, our revenues at the end of the first year were only $20-some thousand. It would have been easy to sort of try something different.
Right.
Move into private equity, try a different investment strategy, go into fixed income, something you didn't really believe in. And I thought that, no, I should stay in the area of investing that I believe in. And then people could see that we were getting better at it every year, not only with our investment performance and results, which are critical, but we would get better at communicating exactly what we were all about. Because I thought it was really important to have this idea that everyone understood exactly what our strategy was, how we were going to make money for them, and I wasn't going to be bouncing from here to there based upon how we were performing at the moment.
I think critical to being able to do that is capital, right? Because if you make $20,000 and you don't have the equity and you've got people to pay and expenses, then that's the problem. That's why we're here today, is to really talk about capital. Can you talk to the MBEs, particularly in the room, about the some of the lessons that you learned, particularly in your early stages at Ariel Investments, of raising that $500,000, and then you had to come back to the markets, of course, to get more money. But how did you do it? What was critical? The
main thing was that I had the story that I thought was compelling, that we were going to be the first. We were pioneers. We had a different way of investing. So when we went to sit down with people, they would say, geez, I've never heard a story quite like this. And we weren't a Me Too firm. Okay. We were trying to do something original, which I think captured people's imagination. The other key thing, I know all of you guys know how to do this, is that I went to people and asked them to give me money they could afford to lose. So I raised that $500,000 basically in sort of $25,000, $20,000 slots. Okay. So that it was kind of, most of the people, were, it was meaningful to them, but it was also, again, money they could afford to lose. And I think that's critical. I have people come to me all the time, I need $3 million. And well, I don't know where, I can't help, and
right.
And then everybody's wasting their time.
Right. I notice also from your website you have a list of books that you recommend, and at the top of that list is Warren Buffett's book, or biography. And I have to ask you, those early investors, they must be pretty pleased at this point in their investment in Ariel Investments?
They are. People made
including your mother.
Yeah, well, my mom made a lot of money, my dad's made a lot of money, and my friends, which is kind of cool. You all want your investors to do well. Those early investors did extraordinarily well, and we paid out lots and lots of dividends, and we bought back a lot of stock. One of the mistakes I made is that I didn't have a very good, especially those first 2 rounds of financing, a way of forcing people to sell the stock back to me. And so I ended up having to pay much more than I would have if I had negotiated more effectively with those early investors. So even though 2008 came and it was a horrible period and we lost a lot of assets and people redeemed their mutual funds, and people who had us in their 401k plan dropped us during that tough period, people that made so much money before then, I think they were willing to live with us during that those lean years, and the dividends collapsed. But now things are back on track. We've had great performance since the March 9th bottom of the stock market in 2009, and so money's starting to flow again, and which has been great for us.
Well, we're reading a lot about the stock market now, making new highs and so forth, and your strategy of really picking companies that are going to do well over a long term. Can you share with us some of the specific things you're looking for when you are, because you could invest in hundreds of companies, but you have to make a choice, thousands of companies. So what are you looking for? And frame that from the perspective of the MBEs in this room, who are also looking for money, and it might give them some perspective of what financial people are looking for when they're looking at companies.
Well, I think there's a couple of things there. One is that for us, we like to invest in what Warren Buffett always talks about: invest in your circle of competence. We like to invest in businesses we understand, that make sense to us, and we're not going to invest in a little bit of everything just because everybody else does. And I've had a chance to spend some quality time with him. I've gone to Omaha to have dinner with him, and he always reinforces that theme. What we look for in those companies, though, once we understand them, is you want to make sure they're in businesses where you think they're going to be around for the long run. They'll be able to grow consistently 10, 15, 20 years down the road. There's not going to be new competitors coming in. They're going to knock them off their stride. So that's why you don't see us in new technology companies. We all know BlackBerry was doing great, and then Apple came in, and now BlackBerry's struggling. You see that time and time again in sort of new industries, new technologies. We'd rather find something that we really truly believe is going to be around for the long run. We're looking for companies that have high profit margins. We think that's very, very, very important, and they can sustain those profit margins over time. We want companies that have strong balance sheets, that they can weather the storm in case that inevitably something does go wrong and someone comes in and disrupts the market for a while, or the economy goes into the tank like it did in 2008. You want to make sure the financial strength is there. And then for us, we want to buy those stocks while maybe they're out of favor, where people are down on the industry, down on the stock market. That's what we want to do, is we always want to buy bargains. And it's human nature. People love to buy things that have been going up and up. Right. It's just so fascinating. For us, the best time to hire us was in March 9th of 2009, when our record looked terrible. We were underperforming. People were scared to death of the stock market. And that was the time to hire us. Since then, we're up almost 300% in our flagship fund, the Ariel Fund. And now it's time to be a little cautious. We love money coming in. Right. As I said earlier, we're getting some nice new clients. But at the same time, I wouldn't be as confident and comfortable buying companies that have gone up so much over the last 3 years.
So you consider yourself a contrarian type of style?
Very much so. I'm going to be buying when everyone is selling and selling when everyone's buying. Again, I hate to keep mentioning Warren, but he always says you want to be greedy when others are fearful. Mm-hmm. And just think about it. Back in 2009, there was an enormous amount of fear. And I can remember I was fortunate to co-chair President Obama's inauguration. And I can still remember how exciting it was, to be there in Washington, to be in the motorcade. But then I kept getting these texts from the office telling me how the stock market was collapsing with the new president. All my favorite stocks were just making new lows. But again, that was the time period to be buying.
Now, you didn't mention management and what you were looking for. Is it that when you're the types of companies that you're buying, management is plain vanilla? Does management make a difference in your investment strategy?
It does. I gave you the top priorities, but you're right. I was remiss in not saying that the other key priority is getting to know management. We go out and visit companies. One of our Boston area companies is Charles River. Okay. They have warehouses full of rats, that help healthcare companies to do the testing, and that's my job. Go visit, see the plants, see the factories, and then sit down with management, the CEO and the CFO, and look them in the eye and determine whether I believe in their strategy. And often companies are telling us their strategy when they're having some problems, and again, when the stock is down. So you have to sort of see, do they have a plan to win that's going to get things back on track and allow them to get back to that consistency that we talked about that we want to see in the business.
So you hinted at, and people are going to be running out of here. The market is closed now, so it's too late to. Well, you got 1 more minute. So if anybody runs for the exit right now, after this next question, I understand. But when you pull out your crystal, do you have a crystal ball, first of all? And if you do, when you pull it out, what do you see in the short term, and maybe highlight some industries?
Well, I still think in the short term, there's still some momentum here. So I said it, we're more cautious than we were 4 years ago. But I do feel money is just starting to flow back into the stock market again. People are putting money in the mutual funds again. A lot of people are starting to take money out of fixed income and moving back toward equities. So that fear is receding and people are getting more confident and comfortable. So I think for the short term, it's going to be fine to invest. Sectors that we like are some of the healthcare companies have been very, very beaten up. So beside Charles River here, we like a company called Hospira that makes generic injectable drugs. That they've had some FDA problems, and one of their factories has had some difficulties in North Carolina. But we think that they make drugs that are very valuable, and they're getting things back on track. We like a lot of media-related companies or companies that benefit from properties that you have a chance to watch on television. So not only do we own CBS, and we own Gannett that owns USA Today and television stations and small newspapers, but we also own International Speedway. That's the NASCAR people. So I'm not sure how many NASCAR fans there are here. You know, I'm one in the back. I went to my first race this year as part of the job, you know, and got to walk the track in Daytona. But if you think about it, those races are on television all the time. Madison Square Garden has been a relatively newer stock the last 2 years. And you think about that, it's a great business. You know, there's no replacement for Madison Square Garden. Right. It's going to be there 50 years from now. Maybe it might be in a new location, but it'll still be the Garden, and the Knicks will still be playing there, and the Rangers will be playing there, and hopefully the Liberty. And you know, it's very consistent. But again, it's a great television show. You know, people want to watch those Knicks play every week, like you guys watch the Celtics play all the time. And
well, I watch the Knicks, son. Don't
Yeah.
split those. Because I live in the New York market some of the time, at least. But I like the Celtics. Don't get me wrong. Can you talk to us? You know, I know you spend a lot of time on community. I would say not direct business things. You have the Aerial Academy, and I've always believed that entrepreneurs, business people, need to be really involved in their community, and I know that you are. Can you talk to us about that particular activity and how it relates to the business, if you will?
Well, as I mentioned earlier, my father got me started in the stock market at an early age, and as we were thinking about how to organize and coordinate our community activities, we thought, can we try to figure out a way to give young kids in sort of disadvantaged communities a similar type of experience that I had? So about 17 years ago, we started the Aerial Community Academy Public School. It's K through 8 school. It's actually 4 blocks from the president's home. It's in 46th and Greenwood, kind of a tougher neighborhood that's, for those of you who know Chicago, it's called North Kenwood, Oakland. And it's a shifting neighborhood. But Arnie Duncan, who's the Secretary of Education, of course, was working at Aerial at the time. He came up with the idea of the school. I said, well, if we're going to have a public school with kids, we need to teach them about the stock market and investing. So it's become really a role model for a lot of people who are interested in financial literacy around the country. Every first grade class gets a $20,000 class gift, and then the kids watch us manage it for the first 6 years. And then in 6th, 7th, and 8th grade, the kids start to pick their own stocks, work with our analysts on how to do research on publicly traded companies. And we go down to the office, and it's kind of nice. And we have a couple of full-time people there that work with the kids and teach them the financial concepts they need to know. All the hallways are named after famous streets like Wall Street and Peachtree Street and LaSalle Street. And we have an opening bell. And the final part that people like, I think, in 8th grade, when the kids graduate, they take $20,000 and give it to the next first grade class. And they take the profits, and a portion of the profits are set aside for a philanthropic gift, often to a need at the school, like a new microphone or upkeep of a new computer or whatever it happens to be. We teach the kids the importance of philanthropy. And then if the kids put the money in the 529 program, the rest of the profits are divided among the students, and if they put their share into the 529 program, we match it with $1,000. So the kids learn matching to get themselves prepared for, you know, a 401k or a 403b or a 457 plan as they get ready for retirement. And the final thing, I love talking about the school, we try to get the kids exposed to as much as possible. So we've had everyone from Magic Johnson to George Lucas down to visit the kids. I'm on the McDonald's board of directors, so every year we take them to the McDonald's annual meeting. And the last 7 or 8 years, they've had a chance to meet with Don Thompson, who's now the CEO of McDonald's, Andy McKenna, the chairman of McDonald's. They get a tour of Hamburger University after the annual meeting. You know, it's a real fun day the kids look forward to, and we just want the kids to be exposed to as much about the stock market as they possibly can.
That's a great contribution to the community and really a great story. And I know we have some folks in the room today that are working in the area of financial literacy here in Greater Boston, and I'm sure we may hear from them later with some questions. Before I turn it over to the audience for some questions, though. I do want to ask you about in the companies that you're investing. I mean, we're a supplier diversity organization, and we are here to promote supplier diversity in corporate supply chains. You're on the investment side. You sit on some corporate boards. Can you share with us your perspective of sitting on those corporate boards, investing in some of those corporations? Where is supplier diversity right now on the sort of the corporate consciousness in your view?
Well, most places it's not on the corporate consciousness.
Okay.
I mean, it's all a big charade at most companies. And
Okay.
I've been investing in public companies for 30 years at Ariel and 2.5 years at William Blair. And
Can we quote you on that?
sure, it's
Oh,
you know, and I, you know, what we try to do with the companies we invest in, when I sit down with those CEOs and CFOs that I referenced earlier, I ask them about the diversity of their board, the diversity of their management team, and I ask them about how they spend their money. Mm-hmm. And most of the time, when it gets to this, sometimes they'll have one board member, you know, sometimes they'll tell you their plans on employment, but when it gets down to spending the money, very, very, very few companies really take it seriously and spend money with people in the categories that they really care about, which is the second part of the point. So one of the things that I've been trying hard in Chicago to get people to do is to sort of start keeping track of the spending by category. Because I always tell people that these guys, they know better. You know, our Mayor Emanuel, is public knowledge, he made $17 million in 2 years when he was the, investment banker. He took that money, of course, and created a phenomenally successful political career because he was working in a part of the economy for those few years that he was out of the public sector that generates lots and lots of cash. We all know this last presidential election, the president ran against Mitt Romney. He was worth several $100 million. We all know that. He had helped start Staples, which you guys all know well. Think about all the jobs that he controlled, and all the board seats he controlled, all the contracts he controlled, and all the philanthropy that went to enormous organizations, obviously a lot to the Mormon Church, which is his right to do. So what I try to get people to see is that we sometimes, whatever small amounts that these corporations are doing with supplier diversity, they're often doing it in the parts of the economy where the wealth isn't being created. Mm-hmm. And it's not to sort of say some businesses are better than others, but some are much more profitable. I always ask people to guess, how much did the top top hedge fund manager make over the last 5 years in 1 year? Anyone want to take a quick?
$3 billion.
So you had $3 billion. You had 100 million. 100 million. Okay.
2.8. I think.
Hmm?
I think it was 2.8.
Yeah. Well, John Paulson. There's a lot of people who are close. John Paulson from Paulson Company 1 year made over $5 billion personally. Right. You weren't. You were close. And he had a vice president. It's in the book, The Greatest Trade Ever Made. Right. He had a vice president who was on vacation, and the wife went to the ATM machine and found a surprise over $150 million bonus.
The limit on the ATM machine, though, you can only take $400 out. But that didn't stop her. She can come back. Right?
So, and he just gave, he gave $100 million to the Central Park recently. It was announced. So that's a long answer to say that the supplier diversity programs are not only behind where they need to be, but there's often a focus on the parts of the economy where the wealth isn't being created. And so my goal when I get involved with these conversations is to say, hey, you guys can continue to do the things that are going on in the supply chain, great, but you also have to include people of color in the parts of the economy where the wealth's being created and the jobs are being created. So that if somebody here in the room wants to start a private equity firm, you want to be able to go to GE and get them to hire you to be one of their private equity managers. Right. And then you'll end up, you'll be as wealthy as Mitt Romney and be able to do all the wonderful things he was able to do with all that wealth. And we need to be included in that part. The people, have law firms, accounting firms, and consulting firms to go along with the construction firms and the procurement types of things that go on with supply. But we're often not being taught to think about that. And so I'm trying to make sure that everywhere I go, that we tell people, we know better. You've got to include us in the parts of the spend that matter. Last thing I'll say on this part is that there are some companies that are doing a great job. McDonald's is the best of the best. You know, they've always had great suppliers, great franchisees. They're starting to work on professional services more aggressively now. Exelon in Chicago is doing some terrific things, you know, one of the largest utilities in the country. University of Chicago has led the way in the nonprofit world in Chicago, and now Northwestern is following in the U of C's footsteps. Because if you think about it, I'm not sure how it is here, but up until the U of C started doing the right thing, the museums, the hospitals, the universities that are some of the largest employers, largest spenders, had basically been doing almost nothing with our community. But now that's starting to change in Chicago.
Well, thank you. Well, I want to take this time now to open it up to the audience, and we'll take a few questions. Please stand up and say your name and your company.
Hi.
Thanks for your remarks, John. I'm Kelly Chun. I run a public relations and marketing consultancy, 21 years old. We focus on social change, promoting social change. I have a question about investing internationally and how you look at emerging markets as opportunities to invest. You know, the president has a Doing Business in Africa initiative, which actually you mentioned at one of our last meetings. So I'm wondering how you look not only at the continent of Africa as various countries as investment opportunities, but other parts of the world as well, like Brazil.
Yeah, I'm a little different on that. I mean, it's funny because obviously I have enormous respect for the president and the administration, and I'm friends with David Hinson, who I'm sure a lot of you know. And you know, David was in Chicago talking about the fact that we as minority entrepreneurs need to focus on being green and global, and green and global, and global and green. And then I was on a panel right after that with Jim Reynolds from Loop Capital and Quentin Primo from Capri Capital, and they were talking about their expansion around the world. And I kind of said, well, you know, I'm a little different. Instead of focusing on being green and global, I'm going to focus on being black and local. And it sort of got people a little surprised. But, you know, for me, I want to get the, you know, I'm trying, I just finally got it after 30 years. We got the R Institute, that's right across the street from us as a client. And you know, there's just so many headquartered buildings in Chicago, so many institutions. I could create an enormously successful money management business just doing business with companies in the Chicagoland area. And so I worry that if I'm out trying to do business too far away, I'm going to struggle to build and maintain the relationships in our local community. So even though we have 80 teammates at Ariel, and you know, I'm Melody Hobson, our president, but we're traveling all the time. We've got so much on our plates. There's so much to do here in America. I have a hard time figuring out how I'm going to maintain it and build it and do it overseas. So I'm a little more focused, I know, and I know I'm a little irreverent on that issue. And I know I'm in the minority on it too. So, yeah.
Yes, go ahead.
Hi, I'm Dory Blades with U.S. Eco Products. I distribute green products, all manufactured in the U.S. My question is, you're on a couple of board of directors. At what point did they seriously look at you when you come in their field of vision?
Yeah.
Because as we all know, they select people for their boards that are just like them.
Yeah.
And just wondering, and how much that has helped you in your business too? Does that bring additional business?
I'll answer the last part first. You know, it actually doesn't. And when I'm on a corporate board, you don't always have to do this, or on a nonprofit board. We won't manage money for one of those institutions. And so we have so many of our folks at the firm that are leaders in certain, you know, board rooms that it's not been helpful to the business directly. It's helpful to gathering information and insights when you get to sit on boards with other CEOs. It's great to be able to pick their brain on what's happening with their industry. I learn a lot about best practices, like McDonald's, to watch how how Jim Cantalupo, when he came back and took over McDonald's 10 years ago, how he got it back on track. And to hear the history of Ray Kroc and Fred Turner, who built that business, it's an extraordinary learning lesson. Or to watch Jamie Dimon when he took over Bank One when I was on the board there, and see Jamie, I think he fired 17 out of 18 people, totally transformed the culture before he sold it to JP Morgan Chase. There were so many lessons learned there. So there's a lot of benefits that don't directly impact our bottom line at Ariel when you're on boards. Getting on boards, my mom used to always tell me this, it's kind of like running for vice president. You kind of want people to know you're available, but you can't kind of lobby for it, because it's one of those, it's a little bit of a delicate approach. So the two things I would give you examples. One, for myself, my first boards came from working in the nonprofit world, like people say. I was involved with helping a guy named Pat Ryan on resurrecting a old ballroom on the south side, and he needed capital, and I think he needed some minority folks on the nonprofit board or the fundraising committee or whatever it was at the time, because Pat lived in the North Shore and was very generous to Northwestern, and so this was something he was doing in the community, and so somehow he got my name and asked me to help out, and I showed up at everything, wrote checks I couldn't afford, just tried to be a good teammate the way my coach at Princeton had taught me to be. Played basketball there, and so then he called me like a year, 6 months later. He invited me to a dinner party out at his home. He had a vacation home in Lake Geneva, and so I went. And then he called me to have breakfast, and he asked me if I wanted to be on the board, be on Aon's board. Pat Ryan was the chairman and CEO of Aon, the largest insurance broker in the world, and that's how that happened. But it came from being actively engaged in a nonprofit world and doing a good job.
Right.
Now, Melody Hobson, our president, the quick story on her, she just gave the story earlier this week in New York. She loved Bill Bradley and worked hard for Senator Bradley when he ran for president. And she just basically volunteered all of her free time, again, wrote checks she couldn't afford, to the point where Bill just became totally dependent on her in a lot of ways as one of the senior staff, even though she was working full-time at Ariel. Of course, he had senior staff, but she was going to volunteer. And she flew with him, did everything. Ended up that she was on all the calls, and she was contributing fully. And Howard Schultz was also on a lot of those calls, the founder of Starbucks. And after the campaign was over and we lost, Bill Bradley called her and said, Howard Schultz has been so impressed by how hard you worked for me and how you got things done. You made such a difference. He wants you to join the Starbucks board. And again, it was just showing being a great teammate with no expectations of anything happening. And then Howard then introduced her to Jeffrey Katzenberg, and now she's the chairman of DreamWorks. And it's like all of these things happened because she had the right spirit of doing things for someone else, and it came back to help her.
That's right. Fantastic. We have time for two more questions. Tony?
Tony Rodriguez, Daniel Penn Associates, and we are a consulting group that supports corporations on efficiency improvement and also supply diversity. I would say that we work with Exelon Energy, and it's good to know that they're rated in the top 20 in terms of supply diversity spent. But my question is, when you take a look at a company, do you look at demographic segmentation? And as a Hispanic, knowing that our population will be 1 in 3 by 2050, obviously a significant buying power. How do you bring that into sort of analyzing a company, whether it's a good company to buy based upon the products that they make and the marketplace that will be needing those products?
Well, it's part, my job when I'm sitting down with management teams is to try to talk about how that business is going to develop over the next 5-10 years. And part of it in a lot of industries is, are they going to be able to expand their customer base? Are they going to be relevant to a more diverse world? And so we will lead management teams through questions about that. And then afterwards, when they tell you how important this is, then we'll say, well, I'm looking at your pictures of the people in your annual report for your management and your board of directors, and I don't see the diversity there that reflects your ambition to build these customer relationships. And we've had a lot of good fortune after starting that kind of conversation that then they'll call back and say, well, can you help us find some people of color for the board? And my chief of staff is here, Ellen Shube. We work really hard to come up with great names to send to those companies when they have that dearth of diversity. And sometimes they pick people we choose. Sometimes they pick someone else that a headhunter recruits for them. Sometimes they ignore us altogether. But I think it's an important part of the conversation. And I think we have some credibility around it because we also, I'll give you a longer answer than you wanted, but we run a conference for African Americans on corporate boards every year with Russell Reynolds. And we've been gaining more and more Latino directors to come to our conference. And the whole spirit of that is for not only for people to know each other and share best practices and learn from each other when board seats are open. The other big thing is to inspire minority directors to realize that once they're in the corporate boardroom, they have a responsibility to address the civil rights agenda aggressively and effectively. Because too often when we get on the board or get on the management team, we get quiet, we get shy, we stop fighting for inclusion and fairness, and in effect we give cover for the status quo to stay the same. And so I think it's always important for more of us to be there, but we've got to have the right people there who are willing to fight.
Fantastic. We have one more question from the audience. Well, seeing no other questions, and I'm not missing anyone, I want to thank John Rogers and his team for coming and being with us.
And my other colleague is here, Malik Murray, who is a
Please stand up, Malik.
terrific guy, and just I wanted him, and Ellen's in the back.
And
Thank you guys.
so this concludes the formal part of the presentation. We have the room in the area until 5:30, 5 o'clock. So please come and introduce yourselves to folks. If you don't know, I can really encourage you to do that. And again, thank you, John, for participating.